A $32 billion empire, a 25-year sentence. Between them, a single line of code. One conditional in the liquidation engine of FTX exempted Alameda Research from margin calls, funneling $8 billion in customer deposits into a hedge fund. Sam Bankman-Fried wasn't running a crypto exchange, he was running a gambling addiction with other people's money. It started the way these stories always do, with a genius nobody questioned. In October 2017, Sam Bankman-Fried, then just 25 and a group of MIT friends, launched Alameda Research. Their strategy was simple: spot price gaps, move quickly, and capture profit. The kimchi premium, buying Bitcoin in the US and selling it higher in Asia, became their first major play. By the end of 2018, internal records showed Alameda moving up to $25 million a day, with cumulative profits nearing $1 billion. Growth was relentless, driven by speed and leverage, not caution. By May 2019, Bankman-Fried introduced FTX in Hong Kong, an exchange designed for traders who wanted more, complex contracts, high leverage, and a platform built by insiders. Early funding came from Capital G, Y Combinator, and Binance, whose backing brought crucial liquidity and credibility. FTX's own token, FTT, launched soon after, drawing in both retail speculators and institutional players. The pace only accelerated. FTX moved its headquarters to the Bahamas, drawn by light regulation and proximity to the US. In January 2022, FTX raised $400 million in a Series C round led by Sequoia, Paradigm, and SoftBank, achieving a valuation of $32 billion. Celebrity faces Tom Brady, Steph Curry, and Larry David lined up to endorse the brand. FTX bought the naming rights to the Miami Heat Arena and ran a Super Bowl ad, projecting an image of security and sophistication. Yet behind the scenes, Alameda remained the true engine. The line between trading desk and exchange blurred, then disappeared. By late 2021, FTX boasted billions in institutional liquidity, masking just how entangled customer funds and Alameda's bets had become. The empire looked unbreakable, but unchecked power was quietly building, hidden in plain sight. He wasn't running a crypto exchange, he was running a gambling addiction with other people's money. The secret wasn't buried in offshore shell companies or legal loopholes. It lived in a single line of code slipped into FTX's risk engine during a late-night pull request in September 2021. The code exempted one account, Alameda Research, from the automated liquidation that protected every other trader on the platform. If Alameda's bets soured and collateral vanished, the system would simply look the other way. Caroline Ellison, the so-called CEO of Alameda, became the chronicler of this internal rot. Her spreadsheets, later entered as trial evidence, show nearly $8 billion funneled from FTX customer wallets straight into Alameda's trading accounts. The money didn't stop at market making or liquidity provision. It propped up losing trades, paid off lenders, and filled holes left by reckless leverage. Spreadsheets tracked the flows. Slack threads, archived and authenticated in court, captured the approval chain. A senior engineer flagged the exemption, and Sam Bankman-Fried responded, "Keep it quiet, we need this for the strategy." The risk team never saw the exemption. It wasn't in the documentation, and the code review was limited to functional updates, not security. The rest of the pipeline, order placement, audit logging, compliance checks, never fired. The single conditional, if counterparty.id equals ALM research account, short-circuited every safeguard. When Alameda's margin ratio dropped as low as 30%, nothing happened. The debt simply accrued, invisible to customers, invisible to regulators, invisible even to most employees. Kroll auditors and forensic analysts later traced the missing billions. The timeline is airtight. In September 2021, the code went live. In October 2022, $6 billion was transferred out as Alameda's margin collapsed. The auto liquidation engine, the last line of defense, had been neutered. The exchange wasn't a marketplace. It was a funding hose, draining customer assets through a back door only a handful of insiders even knew existed. But the real fraud wasn't on the trading floor. It was in a single line of code. And when that secret finally leaked, the empire was already rotting from within. On November 2nd, 2022, CoinDesk published a leaked balance sheet from Alameda Research. The numbers were damning. Over 90% of Alameda's $13 billion in assets were tied up in FTT, a token FTX itself had invented. The market barely had the depth to support a fraction of that exposure. Within hours, crypto forums lit up with speculation, but it was Binance's CEO, Changpeng Zhao, known as CZ, who struck the match. On November 6th, CZ tweeted that Binance would liquidate its entire FTT position, a public vote of no confidence in FTX's solvency. The effect was instant. The price of FTT cratered from $22 to $7 in a single day. Traders, spooked by the prospect of an insolvent exchange, raced for the exits. The numbers tell the story. Between November 6th and November 8th, over $6 billion left FTX's wallets. Blockchain analytics flagged $2.5 billion in outflows during just one 6-hour window. Withdrawal queues ballooned from a few thousand to tens of thousands. Every hour, the liquidity buffer shrank. Internal dashboards, later entered as evidence, showed FTX's reserves collapsing below 5% of customer liabilities. Sam Bankman-Fried, now cornered, posted on Twitter, "FTX is fine. Assets are fine." But the chain of withdrawals was unstoppable. The world watched a $32 billion empire unravel in less than 5 days, triggered not by regulators or auditors, but by a single tweet and a spreadsheet leak. The run was over before the bankruptcy lawyers ever picked up the phone. On December 12, 2022, Bahamian police arrived at Sam Bankman-Fried's penthouse. The world's youngest crypto billionaire, now in gym shorts and handcuffs, was led out on fraud and conspiracy charges. The United States Justice Department had already filed its indictment, outlining wire fraud, securities fraud, and money laundering. The extradition request moved faster than most asset recoveries. By December 21, Sam Bankman-Fried was flown to New York, booked at MDC Brooklyn, and released on a $250 million bond, secured by his parents' Palo Alto home. The courtroom wasn't empty for long. Inside FTX's shattered inner circle, the incentives flipped overnight. Caroline Ellison, Alameda's chief executive officer, signed a cooperation agreement within 24 hours of Sam Bankman-Fried's arrest. Her plea deal required full disclosure of Slack threads, spreadsheets, and the infamous God Mode code. Gary Wang, FTX co-founder, and Nishad Singh, the lead engineer, followed suit. Each admitted to building and maintaining the systems that routed billions in customer deposits to Alameda, bypassing every supposed control. Prosecutors now held an evidentiary pipeline, internal messages, authenticated ledger transfers, and sworn testimony, all pointing to deliberate deception. What began as a liquidity crisis had become a criminal case, with the empire's own architects supplying the blueprint for its destruction. Inside the Manhattan Federal Courthouse, the prosecution built its case block by block, turning FTX's internal chaos into a methodical narrative of fraud. Caroline Ellison, once the public face of Alameda, took the stand in October 2023. Her voice, steady but stripped of any illusion, walked the jury through Slack threads and spreadsheets, each one a nail in the coffin. She described how Bankman-Fried orchestrated the transfer of nearly $8 billion in FTX customer funds to Alameda, rationalizing every move as a calculated risk. The infamous God Mode line of code referenced in the 50-page sentencing memo and confirmed by Gary Wang's testimony became the prosecution's crown jewel. It was not a technical oversight, it was a deliberate route around the rules, approved at the highest level and hidden from the risk team. The courtroom saw exhibits: the September 2021 pull request, Slack messages stamped with Bankman-Fried's directive to keep it quiet, and the internal dashboards showing Alameda's margin ratio plummeting while the system did nothing. Ellison's testimony, corroborated by Wang and Singh, left little room for doubt. The jury, after 4 hours of deliberation, delivered a verdict on November 2nd, 2023, guilty on all 7 counts, including wire fraud, securities fraud, money laundering, and conspiracy. The deliberations were not a close call. The evidence had spoken. The empire was not just mismanaged, it was engineered to fail everyone but its architect. The only question left was how long Bankman-Fried would pay for it. Effective altruism was supposed to be the moral compass at the heart of Sam Bankman-Fried's empire. The rhetoric was everywhere. FTX's profits, he claimed, would fund pandemic prevention, AI safety, and global health. The future fund's audited ledgers showed tens of millions flowing to open philanthropy and the Center for Effective Altruism. Marketing banners promised that every trade served a higher cause, but in the aftermath, the movement's own leaders publicly disavowed him. William MacAskill, co-founder of the Effective Altruism movement, called Sam Bankman-Fried's conduct antithetical to its values. Academics dissected the psychological trap, believing you are saving the world can justify any risk, any shortcut. Dissenters were told they simply did not understand effective altruism. The courtroom evidence included Slack logs, testimony, and the infamous "keep it quiet" directive. It revealed how effective altruism language became a shield for reckless bets and a license for moral drift. Inside FTX, compliance warnings were brushed off with appeals to expected global benefit. The collapse forced a reckoning. Congressional hearings cited FTX as the moment crypto regulation became inevitable. U.S. Treasury and SEC officials called for mandatory audit trails, independent risk engine reviews, and custodial segregation. The case now stands as a monument to unchecked power, the dangers of founder mythology, and the emptiness of moral branding when it is not matched by oversight. The lesson is clear. In the absence of real guardrails, even the most sophisticated rhetoric can become a smokescreen for fraud. He wasn't running a crypto exchange. He was running a gambling addiction with other people's money. Today, trust in digital finance trades at a deep discount. The next empire will not collapse from hubris or code. It will collapse when we forget why this one did. What do you think?